Hello, everyone. Welcome to video 11 of chapter 11. This is the last video I'm going to do for this module 4 chapter. So there's no exercise to do, so I'm just going to go through the slides and discuss the rules. So I don't believe there's any questions where we ask you to do the calculation on the alternative minimum tax, but I want you to be aware of what it's trying to accomplish. The alternative minimum tax. So the reason the alternative minimum tax exists is because high income individuals have a lot of income sources. And because they have a lot of income sources and a lot of control over that income, it allows them to, I guess, use the tax rules to their maximum benefit. So high income individuals often pay little or no tax payable. Now, it's not offensive to the government because they are strictly following all of the tax rules, but the public, it says was extremely upset because this occurred in the 80s, but it's upsetting to the public to realize that someone making vast amounts of money has a relatively small percentage of their income that's actually being affected by taxes. So the solution was the alternative minimum tax. So the alternative minimum tax is an alternate calculation. Whenever we calculate taxes, this calculation happens behind the scenes to make sure that an individual is at least paying a minimum amount of tax. So normally our tax payable calculation's above this number, but if for whatever reason using certain deductions brings this number below, the minimum tax makes sure that, oh, you still have to pay a certain amount. So it's directed at individuals, including some trusts, who take advantage of tax shelters and other tax preference items. In general, an adjusted taxable income is computed, which adds back the tax preferences. So we're functionally redoing the income calculation, not considering certain deductions. When we do the tax calculations on that taxable income, we might come to a different tax payable amount than our normal tax calculation. So in budget 2022, there was an announced overhaul of AMT. This has not gone into play even in the 2024 federal budget, but it is expected that these rules will come into play very soon. So we're going to discuss them, but they're low priority right now because they're not officially taken hold. AMT originally was put in 1986, I think. So AMT's been around for a while, but they found that the calculation wasn't really hitting as many high income individuals as they wanted, but was hitting a number of middle class individuals more than they wanted. So they realized that with inflation and certain calculations and certain tax rules that have changed over the last 40 years, that maybe it's time to take a look at this formula. So the basic concept of the AMT is it adjusts net income and taxable income to eliminate or reduce various tax incentives. Now, it is legal to use the tax incentives. That's why these tax returns were not offensive to the law. They're not offensive to the government, but taking advantage of a significant number of these tax incentives can result in a very low tax payable, even for someone with very high income. So it results in a payment of little or no federal tax. AMT has an exemption amount, own tax rate, and allows individuals on a restricted basis most available non-refundable tax credits. So what it means, AMT has an exemption amount, and that exemption is a certain amount of income that AMT really won't apply to. And the exemption amount is the threshold, I believe, of the fourth tax bracket. So this exemption amount is to make sure that the AMT calculation won't result in a positive number until the income is into those higher brackets. That's how we try to make sure that AMT is only applying to high income individuals. It restricts so it restricts most of the non-refundable credits. The AMT is compared to a regular federal tax payable. The greater the amount is what is paid. The restriction on non-refundable tax credits is half, I think. So most of those basic credits we get, the AMT considers what if this person only got half of the credits that were available to them. The AMTs, yeah. So then we compare that to the federal tax payable, and the person needs to pay whatever amount is greater. If their general tax calculation is greater, they pay their taxes, it's sorted, we're good. If their tax payable falls too short, then the AMT is what they will pay. Excess of AMT over regular tax payable can be carried forward for up to 7 years, applied against future excess of regular federal income tax over AMT. So, what these are saying is these rules are saying your tax payable calculates at, say, $10,000, but the AMT says you need to pay 15. You paid more taxes than the tax law says you should have. So this excess amount paid stays on your account. So next year you do your calculation and now your tax payables is higher, but you've already paid 5,000 of it. This excess tax you paid in the previous year is considered to be taxes already paid. So your tax payable this year will be reduced by that $5,000, that excess AMT, and then you'll pay the difference. So this high income individual over the years, their tax goes below AMT and then above, will net out. So over time, they will still have only paid what the tax law says they should have, but the AMT makes sure that in any specific year, they are still paying a certain amount of taxes to support the government. So the new AMT applies to individuals and certain trusts for 2024. This course is focused on individuals. It does not apply to corporations. The AMT is determined by the following formula. A is the appropriate percentage for the year, which is 20.5%. B is the adjusted taxable income for the year. C is the basic exemption. So we have A, that's basically the tax rate. That tax rate of 20.5 is the second tax bracket. So the AMT is applying to individuals who are in the high tax brackets 4 and 5. And the AMT tries to make sure that they're at least paying these low tax bracket rates. So the appropriate tax rate is 20.5, the adjusted taxable income minus the basic exemption. So the basic exemption for 2024 is 173,000. That's the threshold to get into bracket 4. So anyone who's of lower income is subtracting this C amount. So if your adjusted income is $100,000, it's not high enough to be considered for the AMT. So the new AMT is trying to put in this is putting in this basic exemption to ensure only the high brackets are applying. And then D is the basic minimum tax credit for the year determined under the Tax Act. So we apply our tax rates and then this generates our tax payable, and then we subtract our adjusted tax credits to figure out where we are. I think we do a practice calculation soon. So we adjust our taxable income. The adjusted taxable income for the AMT takes your wages and salary, retirement income, RSP deduction, investment income, and can deduct certain employment expenses, but I think it halves them. But generally, these amounts are not changed. So we're including our income as normal. We don't affect employee allowances. Our net capital losses and farm losses are all treated the same. What gets adjusted are employment expenses are reduced by half. The employee stock option benefit, the entire stock option benefit included in income, no 50% stock option deduction, and ordinary capital gains and capital losses. So normally capital gains are only included in income at 50%. This says, what if we include the capital gains at 100%? So our regular income is included entirely. There's no adjustment. What we're adjusting is those various reductions from income. You don't get all of the employment expenses. You don't get that stock option deduction. You don't get to half your capital gains. It's for this reason that AMT often applies or is affected in a tax payable amount in years where a high income individual has a large capital gain. The following amounts are required. We adjust cap, so we include 100% of the capital gain, and we include 7/5 of the capital gain deduction. So we essentially add a net 30% for capital gain deduction. So this allows that, yes, this person has a large capital gain, but if they're claiming a capital gains deduction, then that's reducing the AMT. Interest and other expenses related to investment, we deduct only 50%, and CPP deduction, childcare expenses we deduct only 50%. So what we see is most of our deductions, most of our credits get halved in the AMT calculation. Capital gains are increased or included 100%. The only deduction that really gets, for lack of a better word, exaggerated is the capital gains deduction. If someone has a large capital gain that they're claiming the capital gains deduction, that will significantly reduce the AMT, basically saying this gain is a specific gain for a qualified small business. We don't want to penalize that particular type of capital gain. So AMTs will often be reduced below tax payable in that situation. Capital gains on donations of property include 100% of the capital gain, claim only 80% of the donation amount. Capital gains on donations of publicly listed shares include 30% of capital gain, whereas normally we don't include the capital gain at all. Claim 80% of the donation amount. For taxable dividends, we're not going to claim the donation tax credit, so we won't do the gross up. Since the gross up is intrinsically linked to the donation tax credit, we just ignore it. We only care how many dollars did you receive. Non-capital losses and limited partnership losses will only deduct 50%. And there's no deduction claimed for CCA, no deduction for losses on rental or leasing property, no deduction for amount by which resource deductions exceed the income, and no deductions considered for tax shelters. So the AMT significantly reduces or removes your access to credits, deductions, and tax shelters. The basic exemption makes sure that the AMT rate is only applying to the high tax brackets. And the personal tax credits are all non-refundable. Only 50% of the tax credits are determined. So you still get these credits, but they only come in at 50%. So we're not going to do, I thought the slides would have an example calculation, but that would just drive home the point we're making here is all of the income, your employment income gets included fully. Capital gains get included 100%. Dividends are received on cash. So all of those combine to say, how many dollars did you receive? What's your total income? And all of the deductions and credits are either reduced by half or removed completely. So that's what the AMT looks for. So we calculate your taxable income under that, I guess I would say, disadvantaged position to see what the taxes are in that scenario. So if the AMT for that scenario is higher than your taxes payable, you're going to pay the AMT. But the AMT is a modified tax position. It's not real. You're not getting all of the credits that are owed to you. So if in the next year you end up owing more taxes, you'll get a credit for that excess AMT amount that you paid. Okay, so that's the alternative minimum tax. That's the end of chapter 11. When we come back in the next module, we're going to be following sales tax. So we're going to jump from chapter 11 to chapter 21. Thank you for your time. See you in the next module.